Federal Reserve just came out and increased interest rates 25 basis points. This was expected. Now the target rate, we're sitting at 4.75 to 5%. And just think about this, guys. This is the 9th hike since May of 2022. 9 hikes since May of 2022, and it doesn't seem like we're going to stop here. They indicated, and we're going to go through all of the data. You can see that Jerome Powell is speaking right now. They indicated that they are still going to do another quarter point percentage bump at some point during this year. Is it going to be the May meeting? I don't know. They've been very data dependent, meaning that they're going to let the data come in. They're going to let this financial stuff happen. They're going to let the inflation numbers come in, so on and so forth. But before I get going on this, subscribe to the channel. Paul's out this week, but I am here, and we're going to go through everything right now. So one of the biggest things that they said is that additional firming will be needed. And we are trying to figure out exactly what additional firming means, because to me, that means that interest rates are going to either continue to increase or stay extremely stable, because Jerome Powell has made it clear in his comments that they are going to fight inflation. He also made it extremely clear when he testified to the Senate and he was getting questions from Elizabeth Warren that they were going to fight inflation. We're going to look at the dot plot here in a second. They are still trying to get back to 2% inflation, which to me seems a little bit asinine, but 2% inflation is still the target. Next, recent developments of the banks will result in tighter credit conditions. Now, this is something that is quite interesting, especially seeing the direction that monetary policy is going. We've seen that Janet Yellen came out, and he actually said this in his little talk right now. All deposits are protected. All deposits are protected. So that means that even over the $250,000, you are going to be protected by this bank term funding program. So these banks can borrow assets against what they have at par. You are going to be protected. Your deposits are going to be protected. We don't know the contagion. And frankly, there's no monetary policy besides this Term Funding Act that will be enacted yet. They do want to see what's going to happen. And Jerome Powell made that extremely clear in the comments being made. Next, this year, the end projection for the Fed funds rate goes to 5.13%. Well, we're sitting right now at 4.75 to 5. So what does that mean? There's going to be one more bump. Next year, this was very interesting comment to me. Next year, and I'm going to pull up the dot plot while we do this, they expect rates to be at 4.3% by the end of 2024. That means that you're going to have some cutting in 2024. In my opinion, it should be a little bit more data dependent, meaning that we should see where CPI is going to go, we should see where PCE is going to go, see where inflation is going to go, see where this banking system is going to go. It's a little aggressive to say that you're going to trim it back to 4.3%, but let's look at the dot plot here. And what this is, for those of you that don't know, all of the Fed presidents go in and they put a little dot where they think that interest rates should be at different points in time. This is 2023, 24, 25, and then the longer run is after 2025. And you can see that the consensus by the end of this year, just over 5%, and that's where you get to that 5.13% that they're talking about. Now you can see that a few Fed presidents think that it's going to be a little bit higher. This is probably somebody like Bullard or Kashkari that are sitting up here closer to 6%. As we move into 2024, you're seeing that the consensus is around that 4.3 number. And as we get further on, they actually do think that their target is going to come down to this 2% range. But you can see the majority of them thinking 2.5%. I think that's a heck of a lot more realistic than 2%. That's continuously what Jerome Powell has said. But I just don't think that it's realistic to get down to that 2% level. Next, core PCE is expected to be 3.6% by the end of this year, not 3.5%. So inflation is still sticky. It is still sticking around. You even saw over in over in the UK, they had an uptick for the first time in 3 months. It's sitting well over 10%, and they're going to make their Bank of England is going to make their decision tomorrow based on interest rates. So we're going to see what happens with that. They said inflation remains elevated. The last time they said it eased. This time, they did not say it eased. So the previous meeting, back in, I think it was February, they said that inflation had eased. And remember, all of those numbers started coming in. They were coming in really great. Then we got the last CPI number. It boosted up a little bit. Core CPI is sitting at 6% right now. Nowhere in the speech or the talk or the document does it say that inflation has eased. So that is something that, you know, when you look at what the Fed says, people are very, very particular in the tone that they take. So you might think that eased is not a big deal, but it is a big deal. It is absolutely a big deal because it is so important to see how particular they speak. U.S. banking remains sound and resilient. That's what they say. They're not going to say anything otherwise. On the economy, there's been moderate growth. Production and spending, job gains have picked up, and they are going at a robust pace. Jerome Powell has been extremely clear that they are going to be perfectly fine losing 2 to 4 million jobs at the expense of those 2 to 4 million people and at the help of inflation. They want to bring inflation down so it helps basically the 375 million other people in the United States, and they will go at those 2 to 4 million jobs that probably shouldn't have a job in the first place. You can go watch a video from previous this week where Paul and I react to that. More notes just from Jerome Powell speaking. All deposits will be protected. That goes back to that little tidbit that he threw in there, maybe a little bit of monetary policy. Housing remains weak. Why? Because rates are high, even though we're seeing that rates are coming down a little bit, but rates are high, inventory is low. So the housing market is a very, very interesting market right now. I'm actually really excited to see what happens there. Real GDP towards the end of 2023 is going to be 0.4%. Not very high, 1.2% by the end of 2024. Median unemployment, they expect to be at 4.5% by the end of this year, 4.6% by the end of 2024, and they are staying committed towards inflation. So what does all this mean, basically? Jerome Powell goes up there a couple times a year, actually multiple times per year, and he talks about what's happening in the economy, and then everybody tears him apart for it. Well, in my mind, you need to look at the things that affect the majority of the people, and that is inflation. I put out a poll the other day on my morning show, as I do about once a week, and I say, is inflation still affecting you and your family? And week in, week out, the number sits between 84 and 86% of respondents say, yes, I still feel inflation. I think that they're on the right path. They need to be targeting inflation, but with the banking system right now, they are between a rock and a hard place. If they continue to raise interest rates or go a little bit more aggressive than the sitting here around this number. Let's say that they say we're going to go 50 basis points at the next meeting. That's going to take us up to the 4.25 to 4.5 number. Guys, if they do that, the market is going to get spooked. And what happens when the market gets spooked? People start taking their money out of banks. What happens then? It just becomes the spiral of contagion of these runs on these banks, and that can be a problem. If they don't do this, let's say that next month, they decide to, not next month, May, let's say that they decide to actually drop interest rates by 25 basis points. Well, then inflation is going to run rampant. So you see, no matter what they do, no matter which direction they go, they are between a rock and a hard place. Two, they did it to themselves. That's exactly what they did. They've done this to themselves over decades and decades and decades. They've already started to do QE again. That's quantitative easing. From the last 4 months, they've taken $300 billion off of their balance sheet. They just injected that $300 billion right back into their balance sheet. That's QE. They were trying to shrink their balance sheet. They were trying to do quantitative tightening and raise interest rates at the same time. It was too little, too late. Now they're doing QE. They're still tightening rates. I do give them credit for that, but that's something that's also interesting. I want to look at GDP real quick before we continue on. So here's the GDP number. Looking into the long run, let me erase this for us. So you see, we have very, very low GDP in 2023, ticks a little bit higher in 24, gets even higher in 25, and then that longer run is sitting around that 2 to 2.75%. That's kind of the area that we're sitting with GDP. So all in all, guys, we do these videos all the time. Subscribe to the channel. You are going to see these types of reactions. You're just going to get data. Notice, things can be scary out there. It doesn't mean that you need to panic. It doesn't mean, oh my gosh, they're going to be raising interest rates to these absurd levels and I need to sell all my stocks. No, that's just unrealistic. Housing remains weak. My home value is going to be cut in half. Don't worry about those types of things. Have them in the back of your mind, but use them as opportunities. Use them as opportunities to go and buy stocks cheaper than they are. Go and buy real estate cheaper than it is when those things actually happen. Understand what raising interest rates mean. Understand what these runs on the banks mean. When you are more informed, you are going to fear a lot less out there. And that's the great thing about our channel. That's the great thing about the community that we have. It's like-minded people. They are all on the same page. And listen, value investing, being in the world of not watching CNBC, not watching Fox Business, not just having those as your main outlets, it is a very, very lonely world out there. That's where people like us, Paul and myself, and the community members can absolutely help you. So subscribe to the channel and do not panic. Have a great day.